everyone. I'm Eileen Yuen, the Managing Director for Gallagher's Financial Institutions Practice. I'm joined today by Andrew Valdivia, our Area President in Glendale, California, working in our Financial Institutions Practice, and one of our specialists in what we're going to talk about today, mortgage impairment insurance. It's an often overlooked policy for our financial institutions. Thanks for joining me today, Andrew.
Thank you, Eileen. It's nice to be here, and I'm excited about the subject.
Great. This is not an easy subject to be excited about, but we do make it exciting. So let's jump right in. Can you explain to us what mortgage impairment insurance is and really why it's important to our financial institutions?
Well, why don't we start from the back of that question or the end of that question?
Sure.
The most important asset on a bank's balance sheet are its loans, and these are backed by collateral. It can be secured real estate or unsecured assets, or maybe just the faith of the signatory. Mortgage impairment coverage is secondary to a borrower's policy, and it's contingent in the event that there's insurance is lacking or insufficient. Mortgage impairment policy will step in and pay for the loss to the impaired collateral.
Great. Thanks. And why is it so overlooked, or why is it underestimated? I find that often it's one of the last things we talk about when our insureds want to talk about their insurance. And why is that?
Well, I think it's a testimony to it being a very low frequency, high severity type of exposure, number one. And number two, the controls and procedures that banks have in place, monitoring insurance requirements and making sure that they have sufficient proof of coverage in place for their clients or their borrowers. But we've all seen over the last couple of years what a wildfire can do, or a flood can do, or a windstorm can do. And many banks and financial institutions learned the hard way that no matter how good their procedures are in place, that following a major event, such as a wildfire or another natural catastrophe, that their borrowers are underinsured or uninsured.
That's a great point. And so can you talk a little bit about mortgage impairment programs in general? Do they all look alike? Is it one size fits all? And if not, are we customizing those for our clients?
Well, to answer your question, there are so many different mortgage impairment programs out there, and it really depends on what the client and their broker establish are important things to address. You can put together a program that addresses simply the perils that are required by the lender, such as fire, extended coverage, windstorm. Or these policies can be expanded to cover such things as earthquake, non-federally required flood. And in some instances, we can even include such things as failure to make tax payments if it's an impound type of situation. So to answer your question, there are very, very narrow programs and very, very broad programs, and the costs impacted by what they choose to purchase as well.
Yeah, so talk a little bit about that for me. How are those programs priced?
Well, it really depends on the portfolio and basically and what they're buying. So if it's a very low hazard portfolio, one that's not in a wildfire area or a windstorm area or earthquake area, or it's a very vanilla type of portfolio, the pricing can be very, very reasonable and inexpensive, and high limits are available. If we're talking about portfolios exposed to natural catastrophes, and they want to secure coverage for those types of perils, the premiums can be very, very significant. There's a wide range, and it really depends on the program structure and what the bank and the broker decides the best option for the bank.
Thanks, Andrew. And finally, I know we have some great tools that are proprietary to Gallagher in the type of programs that we put together. How do we help clients evaluate the exposures to be able to price that for them?
Yes, we have a number of analytical tools available to our clients to help them look at their portfolio and gauge their risk in certain geographic areas to such things as wind, flood, fire, earthquake. A Gallagher forecast, for example, is one excellent tool that we have at our disposal. We also have RMS and air analytics available. We provide that service to our clients at no additional cost to help them gauge and evaluate their exposure that their portfolio has to natural catastrophes.
Well, thanks, Andrew. I appreciate your time today and giving us a little bit of a primer on mortgage impairment and why it is a critical part of banks' insurance programs.
Thank you very much for letting me join you today, Eileen.
Thank you.